Okay, folks, welcome back. This is our economic calendar for the week to come. Monday and Tuesday, nothing really to speak of in terms of economic drivers. On Wednesday in London Open, we have the French Flash Service PMI and German Flash Manufacturing PMI for London Open. And on the New York Open, 9:45 a.m., Flash Manufacturing PMI for the U.S. It's medium impact. On Thursday, this is our heavy hitter for the week. London Open, medium impact Spanish unemployment rate and German IFO business climate. New York Open, for Euro, we have main financing rate and monetary policy statement. 8:30 a.m., news embargo lifts for New York session. Euro dollar, ECB press conference, high impact. So we're going to probably see a lot of volatility on Wednesday and Thursday leading into that. Core durable goods orders, high impact for dollar index. And Friday on New York Open, we have advanced GDP, high impact, dollar based. All right, so let's go to the charts, take a look at things from a technical stance. Okay, folks, here's the dollar index. This is our daily chart. And as you can see, nothing really has changed. I mentioned the last couple of months, we're stuck in this 300 pip range on the dollar index. And I want you to consider what I've said for weeks now. There is a great deal of accumulation taking place right now. It's happening on the funds level, and we don't necessarily know which side of the marketplace is going to go and have a protraction. In other words, the displacement that's due to come. And what do I mean by that? Right now, if we take a quick look at the daily charts of, like, for instance, the euro. Here's a euro on the daily chart, scrunched up really, really tight to kind of give you an idea where we are. We're in a really, really tight consolidation. Now, yes, it's sloping lower, but overall, we're in a rather long consolidation, and we've been winding up tighter and tighter and tighter and smaller and smaller. Every little gyration is getting smaller and smaller. Every swing high and swing low is compressing. Now, it looks like it wants to go lower based on if you looked at lower high, lower low, that type of thought process. And to me, sometimes that works, and then obviously sometimes it doesn't. That's the reason why I have to wait for smart money to get involved and cause a displacement. Once the movement starts, for instance, we had all of the market in this large consolidation here, and then we had a displacement here. It created a fair value gap right there. And then when price came back down into it, it was very easy to determine a willingness to want to go higher in this area because we've already left this range. Now, I'm not saying we have to wait this long, but we're waiting for a similar event. If you look at the cable market, or British pound, we're in a rather large consolidation there as well. We've taken recent sell-side liquidity out, but nothing's happening. It's very, very small movements. Range-bound, contraction, consolidation. Expansion is due. We wait for large funds and the central banks to do their dance with one another, if you will. And that displacement, where we have that huge movement higher or lower, and we do not care. Okay, it's one of those things that are, as a mentor, it's important for me to remind you that you don't always have to know the next move. You don't need to know that. You have to wait sometimes for that information to be provided to you because of the internals, the underlying pinnings of the marketplace, the components, and the players themselves. That means the central bank and the large funds. Those two are the ones that determine where the liquidity is. Now, the central banks provide that liquidity always as a seller of the product or the price, but the liquidity that builds around them providing that and manipulating price through manipulation in IPTA, it will build market sentiment or disrupt market sentiment on a large fund level. Right now, we don't have a very discernible large fund sentiment. So That's why I'm suggesting to you that we have to wait for a large displacement to occur, because the central banks are going to cause some kind of a major move. Okay, because the markets are growing very, very stagnant. It's not good to stay this way. It's important for the markets to be moving around, to be energetic, and that's what I expect to come. Now, obviously, it sounds like Chicken Little, the sky's going to fall sometime, and eventually, when it does, Chicken Little's right. I'm already telling you that I don't know with a great deal of conviction which side the big move is going to occur. As a mentor, and with someone that has almost 30 years experience this November, it's important for you to understand that you don't need to know what that next big breakout is. Because that's the reason why I tell you, even in the free tutorials, don't try to trade breakouts, because many times they're false and we want to see more evidence to it. Sometimes the breakouts are valid and we wait for the market to come back to fair value. There's different ways to approach those markets, but right now it is a day trader's market. It's very frustrating for some of you students that are here that you want to be a swing trader, you want to be a position trader, and I understand that frustration, but there's nothing ICT or any other mentor can do to change the underlying market conditions. You have to either adapt to them or get chewed up and ground up into small bits and then ejected out of the game entirely. So it's with that mindset we go into this lesson and analysis week. So I want to go back to the dollar index daily chart. Now I have here two boundaries. The sellers need to see this low give way, and the buyers need to see this high give way. Now you can argue and say, well, what about this high here? I think the range is defined by this high and this low. We're banging around in there. And that was the reason why I stated on Wednesday that, and I kind of like maybe jumping ahead of myself in regards to the euro dollar, but I stated that we're going to see a consolidation week. Okay, we're going to stay in consolidation. Nothing terribly important is going to see run higher or lower. We're going to be in this for a while. Okay, so how long is a while? I don't know that. I don't know. And that's why it's important. And this is the reason why I teach, try to get 25 to 30 pips a week as your target. That's your objective. If you can get that, you can get that even in a day trader's market. You can get it in a stagnant market. It doesn't make a difference. Now, when the markets are more volatile and they're very directionally prone to move one side over another, in other words, a very clear institutional bull market or bear market, it doesn't make a difference. Obviously, trading is easier in those instances, and it has a lot more opportunity. It gives us a great deal of magnitude, and it allows us to provide velocity to our equity growth. We can turn over that 25 to 30 pips multiple times within a single week. So while the folks outside the mentorship, they know that I talk about teaching to look for 25 to 30 pips. But the problem is because they're in the social media environment, they see people sharing 200 pips, 300 pips, and believe me, they're not collecting real money on that. They're just one of those instances where this is what happened. I'm going to share it with Instagram, or I'm going to share it with Twitter, and everybody's going to think I'm a superstar trader. But you're not seeing real money there. You're seeing demo, okay? And you're not really seeing them get in before it happens. You're not going to see them explain it was going to move 300 pips or whatever beforehand. It's just a lot of nonsense on social media. So I try to be a voice of reason going into trading, because as a neophyte trader, when I first started, I went in with this mindset that I want to be able to do something over and over and over again that is easily repeated. And that was my process for being a day trader in the bond market and the S&P market back in the 90s. It wasn't until several years later that I really grasped the concept that I was able to be consistent with finding very small setups, but it wasn't until I realized that I could take that approach and use compound interest and multiply that same result over and over and over again with leverage, with back then I used the Kelly criterion. It's basically a derivative of what Larry Williams used when he ran his $10,000 account up to over $2 million, but then got hurt in the crash in 1987, and if I'm not mistaken, $1.2 million, a little bit over $1.2 million he had in one year. A lot of risk involved in that, a lot of stress involved in that, but you can really dial in with a modest approach to money management. And I've taught some of those things in free content and also in the mentorship. So you can make it as aggressive as you want to be, or you could be as very conservative as you want to be. So as a teacher, I think that it's important to note that responsibility is yours. It's not mine. So your results, whether they're good or bad, ultimately are not a reflection on me. They're a reflection on what you've done with the content, because I'm a firm believer that what I've taught you and what I'm still ongoing in teaching, and we'll be doing this for years to come, the things that you are told to do, if you work within that, and you also listen to the things I'm talking about when I say the comments in the mentorship weekly reviews, the midweek Wednesday and on a weekend like this one here. When I'm counseling you to be aware that we are in a day trader's market, some of you want to arm wrestle that and say, well, I'm going to trade this way because even though he's a day trader, he may be missing the move. If I'm really beating that drum, it's important for you to know that it's for your edification, okay, and it's for your protection, because I also know some of you are not listening when I tell you in the mentorship, we are not to be trading with live funds, because you're learning about price action and that person in the mirror, because that person in the mirror is going to be the one that either disrupts your success or cancels it altogether. So you have to wrestle with that person, discover what their tendencies are, and they're your tendencies. You just don't think about it until you start really analyzing the results of your choices and decisions in the marketplace. And that's where the study journal is important, because that mindset that you have each day, you kind of like want to compress that before you do any trading into another day. So you want to always reflect on what you've done, how you feel, what you felt like before you went into the marketplace and did things, because 90% of the time I was impatient about waiting in periods like we're experiencing right now. So if I go back and look at all my journals, and I look at all the times where I lost a great deal of money, is because I knew better, but I still did it anyway. It's like that sign that says don't step on the grass, and you know what you want to do. You want to run across the grass. Or don't touch the wet paint. Well, let's see if it's really still wet. It's that impulse, that natural impulse that all humans have. So I try to be that voice of reason each week, and I try to remind you that we are not in a condition that is high probability for extrapolated moves, one-sided direction, easy buys, easy sells, because right now, I'm going to tell you, it's not easy. It's very difficult right now. So one could say, well, you're just fluffing us up right now because you're not able to do anything. Well, you can look at it that way, but I'm also trying to be responsible as an educator, because I'm telling you, because of my own experience, and we're seeing it. I'm telling you that we're not seeing a lot of movement. Don't expect a lot of movement, and it's happening. I mentioned that we were in this large trading range here. We're in the middle of it. Here's the high, here's the low, and I mentioned this in the weekly midweek review. I had the 50% drawn on here. We're gravitating around that. Nothing's happened. There's been really no displacement on the buy side or the sell side. So the markets are very, very quiet. This is a good thing. Okay, this is a very good thing. Number one, it's summertime. It's normal for it to be like this. But it's also wonderful because it's happening ahead of the fall months. There's going to be an excitement, a rush to send the markets moving around before the end of the year. The central banks do it every single year. Do not worry. It's going to happen. But you can't force when it happens, and you can't always predict what side they're going to displace on. So don't think that you have to have all the answers right now. I don't have the answers right now. I'm just exercising patience. I can execute on intraday trades. I can look for short-term intraday liquidity pools and trade within fair value gaps and order blocks to get those things. And I'll kind of talk a little bit about that today on how you can practice. But in this environment, it's really, really important to remember that you don't try to build too much opinion about what the market's going to do, because number one, it's going to be frustrating. You should be observing and learning and studying in this environment, because it can be very tricky. It can be very, it's easy to get lulled into thinking, okay, the big move's about to happen, and I got to get on board right now before the big move starts. You don't need to be a part of the big move before it happens. Okay, the big moves we wait for the smart money. Remember in the Market Maker, maybe that's the Market Maker. It's I think it was a Sniper series. I shared a little picture of a children's pool, and I said, imagine this little children's pool having an elephant in it, and all the water would be displaced out of the pool. When the central banks are moving price, you will not miss it. Okay, you'll see it. Once that big ripple or that rock that falls in the pond disturbs that real still pond surface, those ripples, okay, that's what we want to be seeing. We want to be seeing all those ripples, because between each one of those ripples, there's opportunity to ride outward. Okay, from that central point of disruption, where the rock hits that still pond, where that occurs, you can't do anything in that center. It's already happened. But the ripples, as it's going outward towards each direction in the shore, you can be a part of the movement and the energy by waiting for a market to return to a fair value gap or an order block and reaching for the liquidity. What would be the liquidity in that analogy? The shoreline, because that ripple will keep going out until it gets to the end of the edge of the surface of the pond. So I may sound like a little bit of a FX or Forex Yoda today, but I thought about this as I was looking at charts this morning, because it really isn't a lot to talk about. And when I have these instances in price, I know I just simply turn the charts off and go away and just relax and wait for the market to do something. But because you're paying to learn, and you want to know what's in my mind and what's the thought process and the internal dialogue that I go through, I kind of want to go through that every time we do this, because this is where the real learning comes. Because it's easy to point out when it's bullish, here's where you can buy. Okay, great. Here's when it's bearish, here's where you can sell. And that's easy. No one would argue with that. With all that out of the way, the market needs to have a willingness to want to go below this low. If it does, then we know that we want to reach into this fair value gap, buy side imbalance, sell side inefficiency, return back to 95.90, and also maybe sort out this volume imbalance. Neither the buy side liquidity pool or the sell side liquidity pool is advantageous over the other. I don't have a bias that would lead one direction or the other. So I'm allowing myself to wait to see what they do above this high and below this low. Not excluding the idea that we could pop up here, false break, and then start to come back down, and then we can start worrying about the discount raise here. If we break below the low here and come back inside this range and take out equilibrium, then we know that above here, volume imbalance, and the buy side liquidity pool would then be something to consider. But even in that instance, we could still just break either one of these points and still continuously go sideways. Okay, so just be mindful. That's the condition that we're in. Nothing, unless there's a big movement higher or lower on the dollar index, I think that the foreign currencies are going to still stay stagnant like they are. Okay, so here is the 15-minute time frame. We're going to stay on the 15-minute time frame for both Euro and Cable in the remainder of this video, because there's really nothing to talk about on the daily levels that can't be described here. So we had a correlated pair SMT divergence, as I mentioned, on Wednesday. We traded down, consolidated, had a run on sell side liquidity. I mentioned that we would want to reach up into these inefficiencies and run above. That area is too clean, too smooth, okay, for this level to be there. And because we're in a consolidation market, this is how you practice in this market environment. Look for where the stops have been recently taken. You see that happening here. The low, they violate it, not by much, but it's all it's needed. Then we have a market structure break. As I mentioned on Wednesday, we would look for the market to want to press up, taking out this area in here. But I said that we would not likely take out these equal highs. Now, I got a lot of emails about how I knew that. And instead of answering all that, okay, individually and independently, because I can't keep up with it, I just see a lot of the titles in the emails. And just so you know, the the number of emails I have right now is extremely high, and I cannot keep up with it. It's very high. Our group is big now. So I'm not sure if it's feasible for me to even ask you to send me by way of email any questions that I know that the content is going to answer. So we're getting at that point where it's like critical mass. I just can't get to everyone in a timely manner. Like it's bad. And that's the reason why I use specific email titles. Like when I tweet things, I'll say, look, use this title because it helps differentiate emails. Because I can't open all of them up. And just, I don't have enough time in the day to do it all. So people help me. So when it has to do with new members, they let me in emails. I don't deal with them. Someone else does that. When it is a account-based related thing, like they can't get access or whatever, those titles are for that purpose too. But anything other than that, I'm fielding these emails in the order that I receive them. So one of the emails I got recently, I saw a lot of these popping up, was how did I know that we would see a consolidation week? And number one, it's the weekly templates that you'll learn about later in the future months if you haven't gotten that far. But we talk about weekly templates and how the market generally will trade. This is a consolidation week. The reason why it was consolidation week, and I said that we would not likely break these highs and we would stay in the range, and we have. We stayed within the low created and the high here on Monday. I don't know why they didn't run it up there. They could have easily done that, and it still would have came back in the range, and I would still have said that we're in consolidation. I would have been wrong about them not running the highs here, but nonetheless, I didn't think that we would see it trade above these highs and continuously move higher. They've held this pair in a large consolidation, as you can see. It doesn't remove the possibility of engaging and finding 30 pips. You can find 30 pips on here several different times. And just for the sake of argument, all right, here is 30 pips, this rectangle here. Okay. Price trading down into a fair value gap. Right there. Boom, there's 30 pips. Price trading back down into bullish order block. Here. Mean threshold. Higher. Remember, the draw was here, and we've already done the work by running stops here. And we're in consolidation week. You'll learn all these things as to what makes them a consolidation, but most of what I said pertaining to the dollar index, the first few minutes of the video, those were all the things internally that I was looking at from a template standpoint. So if it's not likely to go higher or lower, it's a consolidation week. So, and the economic calendar didn't have anything lined up for it to create, any other template that I felt for the weekly template. So this is what we had. So buying here, getting out at this point, right there, it's easy 30 pips. Inside these consolidations in here, okay, there's imbalances, there's order blocks, discount arrays, still aiming for the liquidity pool here. Remember, we were already down here, so this is the low end of the curve for the week. The market opened, traded higher on Monday here, and traded softer. We had a run on stops, and then a market structure break on the upside, and I told you to focus on the imbalances here, and then above the equal highs here on Monday and Tuesday's trading, euro and cable. So you can see, without having a great deal of pips as your objective each week, it squashes, okay? It removes, it beats it down, that desire to want to have more, okay? That fear of missing out or greed, because greed is always really one that does you in. Here is the market trading back into a fair value gap. Right here. You can look at it as returning back to the bearish order block as well. You can see it returning back to the Asian range, We had the midpoint of this range here, this low, and this high, 50% of it is right in here. It trades just a little bit above it, creating the Asian range. So we went right back to consequent encroachment of this liquidity void, SIBI, sell side imbalance, buy side inefficiency, and distribution lower. So selling here, running the liquidity out for this low here. That would be your objective. There you go, there's 30 pips again. Okay, so it's important that you know that these things will repeat over and over again when you have a small, low-hanging fruit perspective. Another opportunity here. Fair value gap. Trades back up. Aim for the run on the low here. It does it beautifully here and then expands even further here, running out the low here. So there's 4 instances right there. 30 pips is available. Do you need to trade every single one of them? Or should you try to trade every single one of them when it's in environments like this? No, I don't think you should. Now, invariably, some of you are going to argue with that. You're going to wrestle with it internally. Well, I need to make pips. No, you don't. You don't need to do that. You don't need to do that. You need to be disciplined. Okay, so you have to be aware of these things that are creeping in are bad habits, and you have to squash them. Discipline yourself. Okay, you have to do these things, and no one's going to help you when you're by yourself. I'm not going to be in the room tapping you. Don't do that, Brett. Cheryl, don't do that. Okay, I'm not going to be, no offense to those individuals that are named that in the mentorship. I'm not trying to single anybody out or make fun of anyone. I don't even know why I use those names as the names came to mind. But you can see how the market will seek liquidity when we're in consolidation. So that's how it's going to be the draw on liquidity. In other words, where is it going to go next? When we're in consolidation, you want to see where the stop runs occur. And then once a stop run occurs and displacement starts to take place in the opposite direction, you want to see where do the opposing liquidity pools reside. I mentioned on Wednesday where they were. Okay, so we can see the fruits of it running it here and then staying inside of the range on Monday. We saw that exactly happening here. Now you can see I have also the central bank dealers range, central bank dealers range, central bank dealers range, and then the Asian range here. And again, it's taught to you in the mentorship why I'm electing to use one over the other. And visually, if you look at the periods of time that's more or less outlining the flout, because those 2 time windows is what we're using, then what do we use? We use flout, we use central bank dealers range, or we use Asian range. There's a criteria. It's very simple, but if you're not at that level yet in mentorship, it's not my point to try to point that out because it kind of like steals the thunder from that lesson. But we have a fair value gap here, beautifully traded up into the 124.42.9 level. That was the level here for central bank for that day. Also overlaps with the fair value gap beautifully. Trades up in here. I mentioned on Twitter, I said it's an interesting reaction in euro at the highs. We had a price slide lower, beautiful, runs liquidity out here, returns back to a bullish order block. No necessity to run this one because we've already done the work by running it out here. Real quick sudden movement. Here's the key. You want to look for these types of things. A quick sudden movement, when it does that into an area where we've already revisited and we took out a lower low previously here, I like to see those because it's very indicative of building sentiment or disrupting sentiment. So you were probably looking at this as it was going down thinking, well, we talked about it going higher. This is very disconcerting. Okay, we're really wrong. We're off. ICT didn't have it right. These tools aren't really working for us. Something's wrong here. Nothing's wrong. Whenever you see speed, okay, and look at this single candle. Single candle rams it right down in there and then quickly goes the other direction. There's your Judas swing, okay? Now, obviously, it sounds perfect in hindsight, but I've already told you on Wednesday what we were going to do for the whole week and what we have here as a result. What I'm sharing with you is the levels that I'm deriving at midnight based on the things that I outlined on Wednesday. The template for the week, the overall market condition, what draw on liquidity is going to be most important, most salient right now, and what things are probably not going to happen. So if you have all those things, you know what the past has been, you know what the current price is right now. We're predicting the future, and we are looking for opportunities to take out profits and one or more opportunities in terms of scaling. When the market's in consolidation like this, where it's trendless, we don't have a directional bias that's very clear one way or the other, except for every individual day, it's a new canvas. Are we bullish or bearish for that day? When we have these environments, you want, again, focus on where are the open pools of liquidity. That means the untapped liquidity. These equal highs over here, easily, more or less coalescing around that 112.60 level. So they've worked around 112.60, and if we run above that, 10, 20, or 30 pips, what's it going to reach for? Well, in this instance, they want to essentially the 20 level or 20 pip sweep above these equal highs to get to the 112.80 level. Hit it, and then here's the thing I want you to see. Okay, I took the chart and screen captured it as it slammed into that 112.81.3 level, just so you can see that the high is exactly 112.81.3. Now, I put this on the chart before London even opened up, before price did all this cascading lower. Okay, I shared it on the forum because there's a lot of folks that get wrapped up, okay, in the things that people say outside this mentorship, and it starts to mess with their mind. Okay, like, just because I'm not sitting on social media, running up an account in front of everybody just so I can beat my chest and prove that I can do that, it's hard for me to manage the people I have now. We have a lot of people here. If I did what I showed you here on Thursday, okay, and let's go over to the forum. Here's the post, okay, and you find this post in the news section, okay, and you go into ICT mentorship announcements. I posted this on Thursday, right here, okay, and as price was slamming into that, I wanted you to see what it looks like when I'm calling a daily high, okay. Everyone gets an announcement mailed to them. I can't go back and change this, okay. It's simply, well, it's saying posted 1 second ago because I never refreshed this page. But long and short of it is, you can see when this was posted. This chart is the actual chart shown here. And I want you to see the time. Here's the time and the date that it was created right there. Okay? So this is the chart as it's happening and hitting it. Okay? And there it is, as it's slamming into it. It does not get any tighter or closer or better than perfect. 112.81.3. Now, there's only a few instances a week where I know where this is really going to dial in and give me that reaction. That's how I do my one shot, one kill. I wait for those conditions. Now, what are those conditions? I know you're thinking, all right, talk about that, Michael. Tell me what that is. Well, that's not what this lesson is, but I give you a lot of that information in the core content. And then we go into the price action models. It builds on those things, okay? It's not something that I can say, okay, it's this, 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 and this, and now go out and do it. You have to see me doing certain things repetitively. And it sounds like I'm kicking the can down the road, but guess what? It is what it is. It's very technical. It takes a lot of things that you have to balance back and forth. You have to look at a lot of factors that come together for me to be able to do what I did on Thursday. Now, I'm not doing this every single day of the week because I don't believe there's something for me to do every single day of the week. Now, if I wanted to sit in front of the charts and be on the chat room or being a live YouTube channel, and I wanted to promote myself and make my mentorship attractive to other people, believe me, I would blow the doors off of it, and I would have to hire a company out there to manage people, and it would be insane. I don't care. I'm already well off. I don't need that. I'm showing this, and I showed this on Thursday, just to appease those individuals that were on the fence about, hey, look, you said you could do this. And what does it look like before it happens? Well, there you go. This is what we get. Okay, so everything at that moment took off, went lower, traded back down to an area here. Reaction, consequent encroachment, right between these two price points here. Look at your chart for liquidity void. And it went right back to the midpoint of that during the Asian session, or Asian range rather, I'm sorry. And then we had our classic optimal trade entry, London sell. Distribution, classic return back for a New York sell, aiming for the previous day's low. Now, when we have consolidation markets like this, you want to know what the previous day's high and low is and the day before it. So you're going to work within a 3-day time window. And the market will want to gyrate back and forth and clean those areas up, tap into them. Okay, you can see that the high on Tuesday here, that was eventually swept, as I mentioned on Wednesday's review. That was the real move for the week. Now, once Thursday's market created the midnight candle in here, I knew what I was looking for. Now, what exactly did I look for that held me to the trust factor of 112.81.3? Because I could have very easily posted this chart on the forum, and it could have just blew right on through that, and you would have been asking me, what was all that about? Okay? I was showing you exactly what I was seeing at the moment, based on what I talked about on Wednesday's video. But I want you to take a look at this little area here. This is our fair value gap, right before the double high. Because we're in consolidation, the price only needs to go to this level here. But I guarantee you, if we did a poll on Twitter, if these highs or anything close to it on other people's feeds, this high would have spiked through on some of them. I know it would, because there's a discrepancy between the highs and lows on all data feeds. This comes with the territory. Because I understand that, and I was looking at just this data feed here, I said what I said about the euro dollar on Wednesday being in consolidation, and we would stay in consolidation because of all the factors I said at the beginning of this video. Now, I'm still jawboning. I'm still talking about why and how I was able to do that on Thursday. Do you see? I haven't even scratched the surface yet, but you want me to be able to put a video out, okay? And the people that are in this mentorship, that they just can't wait to repackage it and put it in some other kind of language and make it seem like they've been doing it for decades too. It's not that easy. That's why it takes a mentor, because I have to show you over and over and over again. But you can see the things through my eyes repeating. So you can argue and say, well, you know, I want to be able to do this on my own, and that's the goal. But I've already told you it's going to take you time to get there. You only pay for 12 months, and then after that, you still were working with me every single week. You're not paying me anymore, but I'm still teaching you because it's going to require you to learn more and more and more. So the folks that quit, the folks that have a lot of frustration right now, I understand their frustration. Believe me, I wanted all these things to click for me too. They don't. And there's nothing out there that's going to make me be able to do this any faster than I'm doing. Because the market's going to give you a myriad of different scenarios, and you have to have a process, the things that you look to that mean the most, and then ferret out all the other distraction, because that's what retail thinking is. You're looking at too many things, too many indicators. The only thing I'm in here showing you is specific price levels and standard deviations on 3 factors: the flout, central bank dealers range, and Asian range. That's it. Everything else is interpreting price and understanding where liquidity is based on a weekly template. So everything that I did for this week's analysis is exactly what I taught you in the core content. You just may not have gotten to that point yet to see the weekly templates or the things that we talk about here for the central bank dealers range and Asian range deviations. You probably saw it on some free tutorials and stuff, but I go way beyond all that in the teachings here. Clearly, as you can see here. But I want you to know that when we're in these consolidations, you're focusing on previous day's highs and lows and the previous day's highs and lows in the last 3 days. You want to see that. And they're going to be reference points for runs on liquidity between Sunday's open and Friday's close. Moving into cable. Here's the British pound, and here's, again, when I opened up the chart on the British pound, remember, go back and watch the video, you'll hear me say, right away when we were trading in here, my eye goes right to here. It's too clean. They're going to want to disrupt that. Okay, there's some imbalance in here, and old highs. I don't think I mentioned anything about the old highs, but nonetheless, you know that this is where I was drawing your attention to. So if they're going to come up to that, we think, okay, if it's going to go there, what's it going to do? 10, 20, 30 pips sweep. The liquidity above these equal highs is what they're going to want to reach for. Now, I didn't mention this. This just happens to be just for completeness sake. There's a little volume imbalance right in here. There's no candle, just the wicks in here. I thought that was cute. They went right up here and touched the bottom of that. Kind of like treating it like a fair value gap. The level I had in mind was 112.56.9. That was the calculation from the central bank dealers range. This consolidation and retracement lower, I said that we were going to want to target this level in here. Cable was much cleaner in respect to which pair to trade on. Had nice optimal trade entries in here, returning back to bullish order blocks, and you also had a fair value gap in here that it beautifully traded down into. And yes, this went just a little bit below it again, but your stop stays down here until when? Until you can get first target. So if you were buying the fair value gap in here, say you bought that and you use your stop below here, okay, great. Price goes up, okay, runs a high, starts to have a retracement. What has it done? Has it gone over here and hit your liquidity pool? Not here, it hasn't. It retraces and comes back one more time, runs through. At this moment, right here, you want to take first profit. Why do you want to do that? Because we've taken out an old high, and it's ahead of our ultimate objective, sweeping above these equal highs. So your stop loss would move from here to here only after this high takes out this high. Because this could have very easily topped the market and we could have went lower. That's how we look for partials. You have to know the criteria for taking profits and when to move your stop loss. That's trade management. Those skills are discussed and talked about in the mentorship core content as well. So when I say things like this, you need to be aware of where these things are in the content that we've taught over the last 12 core content months. When you have insights given to you, you want to take these things and put them into a checklist. Now, granted, you could probably have a huge checklist if you try to incorporate everything, but you don't look at everything just because it's available. For instance, we don't look at central bank dealers range or flout or the Asian range unless there's an underlying discussion about where the liquidity is going to be or where's the draw going to be. Because after that, then these levels become important. So on Thursday, I had 125.56.9 pipettes was the level that it came out with. 30 pips takes us into here. So if you look at this level here, here, and here, or even this one here, that would have been enough because it's 30 pips above. I liked this little fair value gap because I thought if it was going to go here, it could very easily expand up and close in there. This little volume imbalance, I did not have that on my chart at the time. I was only really focusing on this closing in. So it would have been this one, and this one could have been just as well. And you can see where we closed essentially at those levels. But the ultimate high came in only off by, what, a pipette? Let's see. 57.8. So about less than a pip. Less than 1 pip. So again, we're looking for a 5 pip discrepancy when we're using these standard deviations. And again, I want to be getting out before it gets to these levels. So as it's moving in my favor, that's what I would like to see happen. We have price trading down to a small little fair value gap in here. This low, 124.31 and 4 pipettes. All it's got to do is trade to that level. And there it is, 124.31.4. There's your institutional order flow entry drill, entry technique. you add 5 pips to that level over here. This low right there. And that little bit of movement there. Filling in, hits it, add 5 pips to it. If it trades that on a limit, you'd be long here. Then all the side of this consolidation in here, this was ahead of the run on liquidity that I outlined and identified on Wednesday. Price trades up, hits it, runs away, creates a fair value gap in here. Price comes back up, fills it in Asian session, or Asian range rather. Price comes down, another fair value gap in here, trades into consequent encroachment, distribution, runs liquidity here, one more time here, and then pumps up into a fair value gap again, returns back to the Asian range low, distribution, fair value gap, comes back, hits that again, small little optimal trade entry, sells off. Fair value gap, trades back up into it again, bearish order block, distribution again. Here again, here's 30 pips. Let's borrow this rectangle. So here's 1, here's 2, here's 3, here's 4, 5. Fair value gap, trades to it here, 30 pips and more. And that would have given you the opportunity to get out using limits for 30 pips. So again, just because there's a multitude of 30 pips available, you only look for one. When you get it, stop. Don't do any more trading. You can paper trade, you can study, but once you get your 30 pips for the week, you have to stop. You do this for 6 months. Build up continuity, consistency, and trust. Because as long as you have this particular skill set, you will never, ever, ever worry about missing moves because you'll always be able to build equity. So where does this leave us? I don't know. We came back in, we closed in here, we turned back to equilibrium, which is being identified here. The low identified for Asian range standard deviation I had was 124.762, and the low 124.762, and the actual low came in at 124.761 pipette. So it only moved one more pipette lower than my calculation. Again, these calculations are done when Asian range is closed, okay, at 4 a.m. or 4 a.m. GMT time, looking at the data feed for our demo account. When that happens, then I have the Asian range, and then only then I can do the projections for Asian range. I can do central bank dealer's range right at midnight, but I can't do flout until midnight total. Midnight in New Day, or it's like 00 GMT. That time you can do central bank dealer's range, but you can't do New York midnight calculations on Asian session, or Asian range rather, and the flout until literally the opening price prints at midnight in New York time. So that's why I say I have to wait. Whenever I ask me, what do you think is going to happen? I don't know. What are you waiting for, ICT? I'm waiting for midnight. I want to see what price is going to open at, and then once I have that, then I do my calculations here. And it's pretty consistent, I guess you can call it. But these levels aren't going to be important to you without context. Because it's so easy for people, and a lot of people say, why did you teach us? This is too good. Well, this is only a portion of what you use to get the daily highs and lows. So when I shared it initially in my free teachings, I knew it would cause a lot of excitement, and it did. But I also knew that the average person could not use it. It would be something you have to study. So just know that we have a lot of learning to do still. Even for folks that have looked at and studied price action model number 5, there's a lot of factors involved with determining daily highs and lows, weekly highs and lows. There's a lot of gray area that we have to fill in. Okay, so just know that there's a lot more learning ahead, and it's important that you weigh me in the balances based on the things I go over before it happens. That's my only reminder. I don't ever want to try to twist anybody's arm to stay here. But if you're not seeing the things that either you've heard me talk about I can do, or if you don't feel that what you're seeing is repeating, okay, it's not important right now that you can't do it. That's not important because you're here to learn how to do that. No one steps through the door and knows right away what's going on. And people, that's been here for a year are complaining they haven't learned anything new in the last month. I have been dumping all kinds of crazy insight, but because you want signals, you're going to think that way. So you can't simplify this. Okay, this is very, very technical. It's highly technical, and it causes you to think. You have to think, and there's some things that you have to weigh. That's why this is never going to be automated. It's never going to be, but believe me, I have dozens and dozens of people that I've worked with over the years that tried to automate this, and they can't, because there's so many things that you have to know from a process of thinking about certain things, weighing certain factors, and visually seeing it. There's no way for, and I am a computer programmer at heart, so believe me, if it could have been done, I would have already done it. That's why I'm thoroughly impressed, because IPTA is moving on some kind of, it's some kind of programming that it will move, and it determines, okay, we've done this, and then we got to go this way now. Okay, we've done this, now we got to go the other direction now. And it attacks certain points of liquidity or returns back to fair value based on some specific criteria. I don't know what that is every single day, because if I did, you never would have met me. I know that there's instances a couple times a week where I got really high probability. And I know there's usually one day a week where it's going to create the high and the low of the week. I know when that occurs. So that's why I stay in this area. That's why I'm a day trader. That's why I'm a short-term one-shot, one-kill trader, because I see that. I have that visibility. I do not have the personality, and I don't have the skill set to stay with long-term positions, because you could easily say, well, you can make so much more money if you hold these big positions. I disagree, because you're putting on a position, and then you have to babysit it and worry about it. I don't like that. I can take small positions and build equity very, very fast with velocity, picking out 30 pips here and there. You can create a career that replaces your job with 30 pips, or you can take that same 30 pips and multiply it and use velocity with momentum in equity growth to see ridiculous, absurd returns. And I got an email from some people that were interested in joining, and I'm assuming it was a woman. I don't know her name. It was Zoe something, and I was really intrigued by her question. She's like, okay, what's the average return on investment per year using your methods, and what's the average return for your best students? And I appreciate those types of questions, don't get me wrong, but how is that going to do anything for you? Because this isn't a fund. I'm not saying, okay, we're all going to participate in this long, and we've invested into one single fund, and the same result that I have is obviously the same result everybody in the fund would have. Well, that's not what this is. You're independently doing these things on your own. So those types of questions I cringe at, because not because I can't prove or show or and educate people to have a really inspiring rate of return. It's that it's a personal thing, and just because I can do something or I can teach it doesn't mean that you're going to have that result. So it just really shows the infancy in the folks that still are trying to get in. And I don't know how I'm going to respond to that woman, and it won't be anytime soon because I got other things I got to do. But it's that mindset that hopefully that you have grown from, and you can see now this is going to take a little bit more work. But here's the thing: the lazy will quit, and they'll never get to those instances where a couple times a month it does line up, and it's very clear, it's visible, it repeats, and it's highly precise. If you can't be comfortable with that, then you're probably not in the right place. And then obviously quitting would be probably the best thing for you. But if you're on the fence about it, just hang in there, because it gets better. You'll learn more because you've been exposed to it over and over and over again. My number one rule is to protect you first, period. If I can protect you from hurting yourself by making poor choices, rushing in before you should, doing things without any idea what you're doing, I've already done you a service, okay? You may not think that, but I have. And then once I can control you from hurting yourself, then you'll have the ability to learn, because everyone has the same opportunity and advantages at that point. But all of you come to me at different levels of understanding, different levels of patience, lack of patience, or you came in with a patient mind saying, I'm not going to treat with life funds until I know exactly what I'm doing. That's the perfect mindset. Those students, they're the ones that are doing really, really well. The ones that are having problems they have financial problems, they're behind their bills, they hate their job, they're probably about ready to lose their job, and you think that putting $1,000 into an account, they'll be able to hurry up and trade and make money to retire on, and none of that ever works. So there's a different perspective you can have when the market's like this than just simply feeling rushed to do something. And I want to remind you, like I tweeted on Friday, the next week's challenge, I send that to you all as students collectively, whether you're in a free mentorship or if you're in the paid mentorship listening to this video. Okay, I want you to look for those objectives. When I give those challenges, I think they're absolutely reasonable. They're the perfect condition for the next week. That's why I do that. The apt pupil will notice that when I do that, and when they're larger objectives, that means that's probably going to be a large move. When I don't think there's going to be a large move, it's usually a very low-end objective. And 30 pips is my low end. I teach people in the free tutorials 25 to 30 pips is enough. If you don't think that's enough, then you have the wrong mindset. Because if you can find that same 25 or 30 pips one time, then once you understand everything else I'm teaching you, you'll be able to find it multiple times inside of a week. Then your 30 pips becomes a 60 pip week, a 90 pip week, a 120 pip week, a 150 pip week. It's all scalable based on your understanding and your experience, but you have to first find that first 30 pips. If you can't easily find that first 30 pips, that's your foundation. That's your unique model across the board. Everybody needs to have that. Because if you can't find that 30 pips and have also the wherewithal within you to say, I can stop right now, unless something extremely easy lines up later on in the week, I am done. Now, I just said something that invites those individuals that don't have self-control to still blow it up. The statement was made with people that have gone through the mentorship. They understand their model. They understand what they're looking for. They can find that 30 pips. And they also know that that 30 pips is, again, exhibiting itself right now in the marketplace. So therefore, I will engage. But you don't risk what you just made in its entirety. You do a small portion of that. If I have done anything this week in this discussion, I'm hoping that I've reminded you that these low objectives of 30 pips are simply enough. They're enough. If you don't believe me, put in whatever amount you want to start with as a demo, or you want to daydream and say it's a live account. Put that amount in, okay, and then do a multiplication of getting 2% growth on 30 pips. Because if you can scale this trade risking 15 pips and you're getting 2 to 1 minimum, you have the opportunity to see 2% growth per week. So take your balance, times that by 1.02 and hit equal sign, and do that 52 weeks. Okay, and that would be a projected goal. Now, a goal is just a goal. It's not a guarantee. But you also know that these 30 pips, you can also lock in 30 pips and let it go. In other words, see if it can give you a little bit more legs and catch more than 30 pips. That's how you graduate and you practice and you build more and more and more. But you have to start with 30 pips. You have to do it. Nothing's changed from the free tutorials in that regard, because I tell you where you should start. There's your aim. That's your target. Hit that. Because if you can hit that, you can do anything you want to do. You want to make 1,000 pips in a month? Make 30 pips first. Because if you can find 30 pips, all you're going to do is multiply that over several different pairs. Multiple days, multiple kill zones. It can happen. It takes a lot of work, but it can happen. You don't need 1,000 pips in 1 month. Is it realistic to expect that? Absolutely not. But it's entirely up to you how much you want to scale it. You want to be big? You want to be modest and small? That's an easy lifestyle. 30 pips, let your equity grow over a couple of years, build it up, build it up, build it up. You won't need a job after that if you're consistently profitable. But you cannot get consistently profitable until you reel in the lack of discipline you have and these exorbitant expectations you have. Oh, you didn't give me any trading plan yet. I have given you multiple trading plans. My question is what have you done with them? You probably haven't spent any time doing anything with them. Those that are cynical. If you have, show me the back data on it. Show me where you've done back testing on it. Every trade engagement, what you've done, what the results were, what was the thought process going into it. Because I guarantee you, those individuals that are very negative and highly critical, they will not be able to produce that. And if they do try to produce it, you'll be able to see that they weren't even following the model anyway. So the problem is always them. Just like it was me in the beginning too. It's hard to admit that. It's hard to just say, I'm screwing it up. I won't follow the rules. I'm breaking the rules, or I'm trying to go ahead of the rules. I'm trying to go in before I should, or I'm getting in too far after when the setup was really there because I'm looking for validation. I'm looking for confirmation. All those things are swirling in your mind, just like they swirled in my mind too. You're always going to have to deal with those things. But you have to really focus in on the marketplace when it's like it is right now. Because this is where you're going to lose all your money. When it doesn't have a trend, it doesn't have a discernible direction, it doesn't have a rhyme or reason. Know what you're looking for in terms of the next liquidity pool, the next draw on liquidity. If you can capture 30 pips out of that, then you're on your way to graduating. That's what you're looking for. Because everything I'm going to teach you in the years to come is just amplifications on how to make that 30 pips bigger and more larger in terms of magnitude, but less in frequency. So with that, guys, that's going to be it for this week. I'll give you all a update by way of the forum if there's anything that's noteworthy in the news section under the ICT announcements thread. And until I'll talk to you then, I wish you good luck and good trading.